what is Buffett doing? So we put out a white paper on it. I've talked about it extensively. I think Buffett sees this multi-year underinvestment cycle. And what it looks like to me is it's really hard for Berkshire to go buy the sorts of small caps and mid caps that I invest in and that individual investors have the great opportunity to be able to invest in.
Hello and welcome to a new episode of the Bull Club, Conversations with Leaders. You can get valuable insights from successful investors and financial leaders worldwide. My name is Sam North, the trading school lead at eToro, and I'm happy to be your host today. Our topic today is on a potential super cycle in the energy world. Over the last few years, we have seen incredible moves in this area of the market, and it has got analysts from all over the globe asking whether we are heading for a super cycle. So are we? What is it? What should investors look out for and also pay attention to? Well, our guest today is Josh Young, an oil and gas investor and CEO and founder of Bison Interests, who has many years of experience and know-how to help us guide us through these exact questions and topics. Josh, how are you?
I'm great. Thank you for having me. And this is a great topic.
Yeah, no, I'm really looking forward to it myself, and I'm sure our listeners will as well. And I guess before we really get into it, and as a bit of an introduction, what exactly would be classed as a super cycle in the energy world? How do we define it, or is it more of a loose term?
Yeah, I feel like when you were mentioning it, I started thinking about that. I think it's a loose term. The way I would think about it is less tied to the economic cycle and more tied to a cycle of the particular thing with the potential for it to last many years.
Yeah, no, that makes sense. And just, on a broad theme at the moment, in most parts of the world, it looks like we're going into a recession, certainly in the UK anyway. In the US, I guess it's up in the air whether it's going to happen or not. And I guess for some people, the idea of a commodity super cycle while we're going into a recession might actually sound quite odd to some people. So how can we have both simultaneously? Is it a case of just having, a continuous strain on the supply side? Is that really what's helping it here?
Yeah, so I think what we're suffering from is recency bias. So oil has been a commercial commodity for well over 150 years. And it just so happens that at the end of the last big economic cycle with the global financial crisis in 2008, that was also the peak of that oil cycle where there had been heavy investment in oil that was increasing from 2000, 2001 up till 2008. So the oil cycle coincided with the economic cycle at that time. And so I think people have sort of in their minds that economic cycle equals oil cycle. But that's not always the case when you think about the 1970s, when you think about other prior periods, the 1940s and even further back. There have been multiple periods where there's been underinvestment in oil that's led to higher oil prices, even with the economy in the US and the world, in some cases, actually doing quite poorly. So they're not necessarily directly linked. And yeah, I'd say the biggest aspect of that is material underinvestment for years, leading to undersupply that's getting worse, not better.
Okay, yeah, and I understand that. And are there certain commodities that you would favor more now than others, or same questions for investors worldwide? Is there like a general rule of which commodities outperform during different parts of the cycle, or again, is it this time is going to be different to the previous one and so on? Is it quite tough, or are there some that you think, I like those a bit more?
These are great questions. So there's an aspect of it where some commodities are operating related versus capital cycle related. So if you think about like iron ore, which is necessary for making steel and building buildings or building cars, so that's very economic cycle related. versus oil, where it's used for gasoline to transport people from point A to point B, and for chemicals and other things that are a little less economically sensitive. So there's this idea of OPEX versus CAPEX. So oil would be more of an OPEX commodity and iron ore would be more of a CAPEX commodity. But then there's also the specific supply and demand dynamics for each individual commodity, such that, for example, natural gas in the US is also a OPEX commodity. It's also used for people to keep the lights on and other sorts of basic things that are a little less economically sensitive. But natural gas is much better supplied in the US than oil is, and it's more of a local market for natural gas versus a world market for oil. So you can have concurrently two OPEX commodities where one does much better than the other. But again, so it's both this sort of global question of, hey, what kind of commodity is it? Where does it get categorized? As well as local in terms of the specifics of the supply and demand dynamic for each individual commodity.
Amazing. So if we just take a step back and, maybe have a little bit of a brief history on yourself, Josh, and then build it into today on how you would analyze an energy company. Is there something in particular that you would look for? And on that point, are there any sort of names that you like at the moment today?
Yeah, so I've been investing in oil and gas stocks actually for more than 2 decades, and then professionally for over a decade. And when I first started to invest in the companies, I used to read the Motley Fool newspaper column before they had a website. And so I was always interested in growing companies that traded at a big discount on easy to assess metrics. So I was first interested in companies that were growing revenue and cash flow. And then I learned more about net asset value, and I got interested in owning companies that were heavily discounted relative to net asset value. Today, I'd say both of those are important, but also there are 2 other aspects that really matter, and in my experience have kept me out of trouble where I've been able to avoid it and have helped me generate extra upside. So one is balance sheets. So it's important that a company can survive a downturn, and under various potential circumstances over the next several years, it's really helpful for them to be well positioned financially. So it doesn't mean necessarily not having debt. In some cases, I'll invest in companies that are heavily indebted. In other cases, they have net cash. But it does mean there being the various balance sheet dynamics that protect the company and allow it to survive even in a downside scenario. And then the other thing I can't emphasize enough is the importance of good management and a solid board. And people say that, and then, it's really easy to say, oh, but this stock is so cheap, it doesn't matter. And where I've done that, more often than not, it's been very painful.
Yeah, I can imagine. It's quite interesting. We interview quite a lot of people similar that are CEOs of companies or have been, investors for a long time, and they all talk about the importance of a good management. And I think for a retail investor, that is kind of underestimated, right? So yeah, very, very important there. If we move on to another very well-known investor in Warren Buffett, he's had a big bet on oil companies this year. I think Chevron, he upped his stake as well, I think sort of during the summer, and then Occidental Petroleum, I think 7 billion worth of shares at one point, I think I remember reading. So what do you think attracted him to those companies, this area of the market? Do you think that for someone like Warren Buffett, would it be, okay, this is a short win for me, short time frame, or is it a case of he's building for the long term here? He sees something that is going to be long lasting.
So I actually attended the Berkshire meeting this year. It's only the second time that I've been to their annual meeting, and I was surprised, just like almost everyone, when they announced that they had bought a significant additional stake in Occidental Petroleum. Yeah. And I actually brought one of I have these $250 WTI hats, and I brought one and I wore it around, and no one understood what it meant in order to be offended by it, right? No one even knew what that meant. $250 oil, WTI as a benchmark for oil. And so I thought it was really interesting because you had tens of thousands of people who were there ostensibly to learn from Warren Buffett, and who there's almost this like weird Buffett cult, but they didn't understand what Buffett was doing. And I think it's a really important question that you just asked, which is, what is Buffett doing? So we put out a white paper on it. I've talked about it extensively. I think Buffett sees this multi-year underinvestment cycle. And what it looks like to me is it's really hard for Berkshire to go buy the sorts of small caps and mid caps that I invest in and that individual investors have the great opportunity to be able to invest in because of their smaller amount that they're investing. He has to go buy stocks that are large and liquid. And so when you look at these companies, the companies he selected, in particular, Oxy, it's the most levered large cap. And so it had the most upside to higher oil of any of its competitors of its size and trading liquidity. So in the prior question, you asked, hey, are there a couple of names that you like? So there are companies that I own stock in that I'm not recommending, but that I like, that are sort of similar, I think, in terms of, good assets, or at least, cash flowing assets, solid management, similar sort of idea to Oxy. I would argue maybe even superior management to them. And then, really significant discount. And again, when you invest in smaller companies, you have a big advantage because in some cases they can be much more heavily discounted than larger companies ever get to. So two of them I would mention. One is Journey Energy, which trades on the Toronto Stock Exchange. Again, I own the stock and I'm not recommending it, but just to frame it relative to Buffett's investment. And then the other is Sandridge Energy, which trades here in the US and is controlled functionally by Carl Icahn, who ran a proxy battle and installed their board. And in both of these cases, it's remarkable because these are companies that Berkshire can't buy because they're too small and they don't have the trading liquidity. But on every metric, they're trading at about half or less the valuation of Occidental Petroleum. And then when you meet the teams and you sort of see what they're doing and understand their backgrounds, frankly, their teams have a much better track record of value creation than Occidental's team. Their boards are much stronger generally. I mean, Sandridge's board, Carl Icahn appointed them. So if you just attribute his track record to them, that works. And it's really remarkable to see individual investors choosing to buy a stock that just because Buffett buys it, instead of doing what Buffett advised, which is he said if he had 50 or $100 million to invest, he'd never invest in the stuff he buys. He'd buy smaller companies. So, I know taking that question a little bit of a different direction, but it's a really sort of interesting dynamic. It was really educational. I'm so happy I went. And I think we're very early in this bull market for oil, given people's lack of reaction to my $250 WTI hat.
Yeah, well, I mean, just speaking of WTI, and you mentioned you've sort of been in sort of the investing world and the trading world for 1-2 decades. So you've seen some wild days. Did anything get on the same level as, I can't remember the exact day, but early 2020 when WTI, the futures went negative, didn't they? They went down to like -30 or whatever it was. And, the market just was absolutely mental. And then obviously since then it's recovered and we're now trading, I think somewhere around sort of early 90s, aren't we? But how important would you say like the futures markets are, for example? I mean, for novice investors, they have no idea really what it would mean, but is that something that you would consider, or are you more focusing on just the companies that are related to oil price?
Yeah, so I mean, I follow the futures closely. I think it's a very complicated market, and I think more often than not, people misinterpret what's going on in the futures market from a variety of perspectives. So, for example, right now we're in backwardation, which means that the price for oil, if you buy an oil futures contract a year out, is actually, I think it's something like $20 discounted versus the price if you buy it for delivery this month. And that's related to there being high demand for oil currently, and there being plentiful storage capacity. You're able to store oil very easily, so it's very cheap. So there's not a premium for storing the oil. So historically, that's been associated with oil prices rising. But people look at the forward curve, they look at that 1 year out contract and say, oh, it's at 80 or 75 instead of 90, therefore oil is going to go down. And when it actually historically has been correlated with the price, the spot price, the present price rising over that time frame rather than falling. So that's just one example. I think it's really easy to misunderstand it. And it's really important to remember that that's not really a market for betting on the future price for oil. It's a market for people who want to lock in the price of their production, accept a discount for it, and essentially use it as a financing mechanism. So again, very complicated subject. It always concerns me when I hear about people betting in that market, because really it's truly gambling unless you're an expert in it.
Yeah.
And there are so many great alternatives in equities where you can own things at very large discounts to their intrinsic value at very low cash flow multiples. It just seems odd, and there's this like allure that maybe is misplaced for people betting in that market versus investing in, good companies with solid management teams at large discounts to their likely intrinsic value.
Yeah, I mean, when I first started intraday trading, which would have been just over 8 years ago now, a few people that I'm still in contact with now are WTI traders, and they've got a certain personality about them. Let me just say that they're wild characters. I mean, the fluctuations daily can be quite remarkable, and I think it moves at each cent that it moves is $10 a contract, and they're trading multiple contracts, so the moves are just insane. But yeah, it's a very fascinating world, oil and the futures market too. If you were a new investor, you're new to this sort of investing world, how would do you reckon people would look to play this? Would it be having exposure to the commodities themselves, whether that be gold, oil, silver, copper, whatever it might be? Or do you think it's not necessarily a safer play, but maybe an easier play to invest in companies that have exposure to that commodity? So whether that be Exxon for oil or whatever, or Chevron, for example, do you think that's a way that maybe that's the route that investors should go down?
So I think there's the question of what's easy and there's the question of what's right. The easy answer is to say that the producers are going to do better, and so you should just buy a energy index and maybe go larger because it's a little less risky. So that's the easy answer. The problem is the easy answer is often the wrong answer. In my opinion, the right answer is to learn a little bit about securities analysis and look around to see where every person has their own distinct advantages and disadvantages. And I think there's the opportunity to be able to buy individual securities because there's so little coverage still and so little knowledge in the oil and gas space relative to technology or relative to other sectors that historically had similar market weightings to the oil and gas sector. So oil and gas, the ETFs or the energy percentage of the S&P 500 right now is under 6%. I think it's close to 5% right now. Historically, it's been as high as 25% in periods where oil has been very strong in an oil bull market. And on average, it's been over 10% even through oil bear markets. So I think there's a great opportunity in the equities, much more so, I would argue, than in the commodities. And then I would argue that you're much better off learning about how to value companies and then buying individual securities that are much more heavily discounted than what's available in the sort of larger market ETFs, while also understanding that it's not an easy thing. And so maybe it makes sense to own a set of these companies rather than finding one and just betting all on one individual company. And again, none of this is personal financial advice. People should also consult advisors. But if I were to start out doing this is sort of what I think I would do, knowing what I know.
Yeah, the route you would go down. Also, I guess right now we're starting to see a global transition to clean energy, right? That's starting to happen. Companies are talking about this. You've got the ESG side of things. How much focus needs to be on this area for investors, and what do they need to look out for? Are there certain commodities in question, and what other factors affect them? Is this an area you like the look of, or is it just something you now need to consider as well?
Yeah, so I mean, obviously I consider it, and I track EV adoption and other alternatives very closely. What I would note is that trillions of dollars have been spent in the last few years on alternative energy, and a very small percentage of total energy production is coming from alternative energy. And so when I look at how much has been spent so far and how little is generated from the money that's spent, as well as the tendency historically for energy consumption to go up, not down, I don't really see alternative energies replacing traditional energy sources anytime in the near to medium term. And so it's always something that I'm watching. And there are alternative energy linked commodities that are very interesting, but even my problem with those is that it's so uneconomic to invest in those globally from a sort of central planning perspective. If you spend trillions of dollars to grow your energy production by sort of 2% worldwide versus spending trillions of dollars for the other 98% or something of the global energy source, at some point, that sort of uneconomic spend, especially if there's a global financial crisis or economic downturn, starts to come into question. And if that spending slows, it's possible that the alternative energy linked metals and other sorts of commodities could collapse because their demand is not economically driven. It's driven by these sorts of government subsidies. So I track it very closely. My assessment is that there's a very bright future for oil and natural gas over the next 5 to 10 years. And beyond that, I don't know that anyone can really predict the future, but the trajectory right now is very positive for oil. And I think the narrative is overblown for some of the alternative energy related commodities.
Yeah. Okay. Let's talk about a potential risk, or maybe you don't actually see it that way. Joe Biden and, talking about taxing the oil and gas companies. Is this something you're pricing in? Is it something you're considering? Is this in your list of potential risks when evaluating companies?
Absolutely. So geopolitical risk is a real issue, and it's an issue in the US and Canada as much as it is, unfortunately, these days in West Africa or South America or various other places. That being said, Joe Biden in particular, just yesterday promised his supporters that he would end drilling again. So I think the particular risk of a windfall profits tax in the US or other sort of punitive measures to oil companies for insufficiently developing their reserves from that sort of political argument perspective seems actually to have been muted. And I would argue that that sort of risk premium should be reduced a little just because it appears that there was sort of this political misstep that'll make it harder to impose those sorts of penalties. But again, geopolitical risk is real. It should be considered, and it should be considered across jurisdictions that were historically considered safe.
Yeah, absolutely. And I guess just on the risk side of things as well, there's two things that really stick out to me. One, I guess, and you'll know this a lot more than I will, is the strength of the US dollar. So I'd be interested to see what you think about that, or potential weakness that could come, which I guess would be maybe a good thing. And the other is China. How do you see that at the moment? And there's obviously rumors that they're looking to potentially come up with a plan to deal with the end of the zero COVID policy. China, the biggest buyer of commodities. Is that something you're factoring in as well? Sort of the US dollar side of things in China. How do you see that?
I have to say, we didn't talk about these questions ahead of time, and these are the things I think about on a day-to-day basis. So I think this is really, these are very important topics and the relevant ones for the sector. So I'll deal with China first. So it's remarkable to me that China hasn't fully reopened already.
Yeah.
They're causing absolute devastation to their internal economy by doing this. They keep talking about reopening. It does appear that it's more of a political thing than it is actually a concern about the virus. It does appear that they're moving towards large-scale incarceration of their population. And it looks like what they're doing is they're locking down hundreds of millions of people ahead of imprisoning millions of people. And so that's horrible from a humanitarian perspective, but it's very bullish from an oil perspective because they are moving towards fully reopening their economy. They're talking about it. They're preparing for it. They're consuming more and more oil now relative to where they were a few months ago, and they're exporting some of their refined products as well. There's been a misconception around refining, which is that there's an inadequate supply of refining worldwide. It's not true. China had millions of barrels a day of refining capacity offline. Russia had some offline, and then there's a few refining projects that are coming on around the world, including one that just turned on in Kuwait and another one that's turning on in West Africa. So there's plenty of refining. It just was off temporarily. And so there was this big price shock, and diesel prices might rise a little more on a relative basis to oil before they fall, but they're going to fall. And so China, I think, eventually ends up being very good from an oil perspective. China locking down has been very negative for them and very good for their competitors industrially. So you look at Mexico and Latin America, you look at Vietnam, these countries are booming and their oil consumption is going to rise. So net, it's actually unfortunate for the Chinese populace. It's very positive for oil consumption. And then, sorry, what was the other question?
Just about the US dollar. I mean, it's obviously it's been on a tear this year. It's been so strong, and commodities priced in US dollars therefore have come under a little bit of pressure. So has that been something you've been considering? And I guess from a sort of a global macro point of view, the bulls, the equity bulls that, they're still out there somewhere, are thinking the Fed may have that dovish pivot soon, and that in turn may lead to dollar weakness. Would that be something that you would feel is ultimately a positive for markets? I mean, to get through a real sort of, what we now in the 11th month of the year where it's just been dollar strength the whole time, if we are to see dollar weakness, is that another, positive scenario?
I see. Yeah. So honestly, I have an economics background. I went to the University of Chicago, and I can tell you, I have no idea what's going to happen to the dollar. And I don't know that anyone knows what's going to happen to the dollar. I don't think the Fed knows. And so what I can say is I have been investing a little more than I would have otherwise in Canadian and other non-US oil and gas producers, because they are beneficiaries of dollar strength. Yeah. So I don't know what the dollar will do tomorrow, but I know what it's done and where it's at right now. And Canadian producers, in some cases, are getting local currency $120, $130 a barrel for their oil. And at least some of their costs are denominated in their local Canadian dollars. So that's wonderful, right? I would love for my US producers to get $120 or $130 a barrel right now. Yeah. So that's a huge advantage. So I'm invested in some of those companies a little more than I would otherwise, because the dollar is strong right now, and it has been. But my crystal ball in general is broken, and I can't pretend to be a currencies expert. So I don't know what'll happen.
Yeah, I think 2022 and the 2 years before that have been pretty hard for analysts trying to predict what's going to happen to the US dollar and what the Fed are going to do. And like we said, maybe the Fed don't even know what's actually going on either. Last couple of questions, Josh. We've talked about this a little bit already, but when looking at individual companies to potentially anyway take advantage of a super cycle, or even just a company that you believe will have long-term success, what are those main things that you look for? And you talked about the management. Are there any sort of non-negotiables from that point that you look for, that if it's not yes for all of them, that company just doesn't make the cut?
Yeah, so I don't think there's anything that's non-negotiable. Okay. But there are a set of things that look really helpful. So at this point of the cycle, if a company is not free cash flow positive without some really good reason to not be. So a company that's rapidly growing production and reinvesting over 100%, sure, and generating amazing returns, maybe they don't need to be free cash flow positive, but there's almost no one that's like that. So companies that aren't generating a lot of free cash flow, that don't have management heavily personally invested in their companies, relative to their personal net worth. So it's not like I expect every management team to own 10 or 20% of their stock. If they do, that's great. But if they don't, they should at least own a meaningful portion of stock relative to their personal net worth. And then, I think there are still these great opportunities where there are these producers trading at large discounts to the externally assessed producing value of their assets. So there are these engineering reports, whether it's on oil companies or natural gas companies or mining companies. You can get these engineering reports, and they're not perfect. They're sort of like real estate assessments, where it's not perfect, but it is a good third-party data point that you don't want to rely on, but you can consider. And so there are companies that trade at large discounts to those, and there are ones that don't. So I'd rather own ones that trade at a bigger discount to those assessments than a smaller. And then the last thing, the mergers and acquisitions and divestitures have picked up. And it's not hard to tell which companies are doing good deals and which ones are doing bad deals. And my criteria here is if a company is doing deals that aren't substantially immediately accretive, it's probably not a good fit for me. But if they are, then it's a great fit, because acquirers, and I think people miss out on this or don't really understand this, and it's going to be I think a big story over the next few years. Acquirers of assets who buy them at highly accretive multiples end up trading a lot higher. Their stocks do really well. There's a framework called a roll-up, where you essentially buy a lot of sort of smaller of the same thing you are. So if it's gas stations or oil wells or whatever, and in the end, eventually they don't always end very well. But while they get started and as they start to grow, their stocks can do substantially better. So I found a few of these companies where they're trading at actually weirdly discounts or in line with their peers, even though they're successfully buying assets over and over again at large discounts to their current valuations. So if they trade at 3 times cash flow, maybe they're buying assets at 2 times cash flow. If they do that repeatedly, that's a recipe for them to maybe go to 6 times cash flow instead of staying at 3 times. The market rewards it. And any individual person might not like it, but it's sort of the collective wisdom of the market ends up bidding them up. So an example of that is Journey. Like I mentioned, they've been doing these asset deals that are phenomenal. Again, small company, I own it. It's also very risky, so people should be aware this isn't a recommendation, but that sort of dynamic is very promising. And I think it's the sort of thing that people miss early on, and then it's very obvious to them, let's say 2 years from now, when the stock's way up and they've done way more deals. Oh, of course, their stock is up because they were doing such great deals.
Yeah. And our last question, Josh, and unfortunately, I'm going to need that broken crystal ball for this one. And I appreciate predicting the future is very tough. But how, and maybe we can just focus on maybe the key trends, I guess, to keep an eye on instead of, where you see the next 1 to 2 years in the energy world. So key trends and where do you see the 1, 2 years down the line? I mean, one of those questions might be a little bit easier than trying to predict the exact future. So maybe focusing on the key trends for now.
Yeah. So, I'll say I don't know exactly about 1 to 2 years, but over time in this cycle, there's a reasonable expectation that oil prices will go to all-time highs. So I don't know about 250 for WTI, but I do think that there's a reasonable case that oil prices go high enough that it induces companies that have promised to never drill another oil well to go drill more oil wells. And you just need the returns to be so astronomical that they can't help but do it. And, you might need $250 oil to do that. I don't know exactly what that price is, and I don't know exactly when, but that's the trajectory. So the big things to watch are the oil rig count, which is still very low relative to the price of oil, both in the US and internationally. Overall capital spend, both for oil drilling as well as for oil field services, which is still also very low relative to the oil price. And then, also it is worth keeping an eye on demand. If there is a really big economic downturn that could delay or extend the oil bull market, and it could temporarily suppress the price for oil. So tracking demand is important. It's just very, very hard to predict. And it's way easier to track supply. The easiest way to track supply is to look at capital spend. Capital spend is still relatively low versus the oil price. And frankly, from my own perspective, once capital spend is relatively high for more than a couple of years, I probably sell my oil stocks and move on because I don't want to be there for the next 2014 type crash or 2020 type crash. Yeah,
no, fascinating. And actually, the $250 oil hat. It gives me memories. I had I still do somewhere in my house, a 25,000 Dow hat. And I know what my next purchase is going to be now in anticipation for the all-time highs. But Josh, thank you very much for joining us today. It's been a fascinating subject, which I know our listeners will care a lot about. And thank you so much for your insights.
Thanks a lot, Sam. I appreciate being here.